So Curly, whenever you're trading very fast with options, I'll start by saying implied volatility is high in the morning, right? In the first moments of the day, volatility is ridiculously high. No matter what happens, basically, throughout the rest of the day, volatility will be lower. So if you're the buyer of an option at 9:30 and 10 seconds, it has to move pretty fast and pretty far to beat the volatility crush. Now that effect slows down in the first, say, 20 minutes of the market open. Volatility settles down, and then your crush will not be so dramatic. You're right in saying that options with more time on them will suffer less IV crush. There will still be some, but definitely not as much. You have to be right. If you're right and it doesn't move very fast and very far, you could still lose money on that, even though you were correct, right? If you're going after a 30-cent scalp in a $75 stock, that option is not going to be the most efficient way to do that tiny scalp. Now, if you're going after a $3 move in that same $75 stock, the option is going to dramatically outperform the shares in most cases, right? In most cases. So if you are going to be in for 10 seconds or 30 seconds or 60 seconds on a trade, like that's one of the reasons why I am trading futures at the open, because often are just, it's like catching a ball of razor blades. Like you might be able to catch it, but you're going to take some damage, right? So it's like no matter how that game, you're going to, like, maybe a little example, but if you're trade off of like a major pivot area, you think you're going to be able to hold the trade for numerous few minutes, the price is going to change significantly. For instance, like a 10:30 turnaround or like a fading a morning push might be a good time to get an option, but the 9:31 is probably a risk time to do. Yeah. Now, end of day is a little different because, so imagine the scenario where you buy an option in that low volatility period, like let's say midday, kind of boring, price moving mostly side. Then the next, you get the price and the volatility is spiking at 9:31 in the morning. Now, that is when you bought it in a low volatility environment and you're selling it in a higher volatility environment. And so that's amazingly. For instance, like in Suncap's trade today, he bought coin calls yesterday, I believe it was, in the afternoon, and then sold them on the surge in the morning and made 70%, in a very short period of time. We had Rhea catching some really big ones, over 1,000%, 500%ers and stuff using the same effect. Price move plus volatility increase, very, very juicy.